Today's webinar is about a very hot topic, which is called global minimum tax and its impact on transfer. I guess the myth that we're gonna bust or not bust today is whether transfer pricing is still relevant after the implementation of global minimum tax. So, Honchan, are you ready to either bust or not bust that myth?
We shall see. Yeah,
yes.
Definitely.
That's the million-dollar question. So before we get into the detail, let's give a brief introduction of our firm for those who do not know us or who are new to our popular webinars. So just a small disclaimer for everyone that this presentation is for general discussion purposes and cannot be relied upon as a specific advice and is copyright of Transfer Pricing Solutions. So with that, just a brief introduction. We are a consultant firm that specializes in advising multinational companies in the Asia-Pacific region and globally on transfer pricing by being proactive, practical, and cost-effective. We have 3 offices whereby we cater to all multinational companies around the world, 1 in Australia, Singapore, and Malaysia. Honchan, we confirmed that we are recording, right?
Yes, I think it's recording. Yes, it is recording.
Okay, good. We are considered tier 2 firm, and we are very frequently contributing to industry journals and government agencies in all countries, because obviously apart from our consulting, as you can see in our webinars, we really love to share what we know and what we do with the industry. So let me introduce the 2 presenters for those who are not familiar with us for today. So Hon Chuan Tan is the director and technical lead of Malaysia with over 10 years of experience in transfer pricing and also a pioneer in developing transfer pricing practices in Malaysia. So we're very lucky to have him over the past 5 years plus. This is his 5-year anniversary. So we're very lucky that he has been working with us for such a long period of time. He specializes in the area of transfer pricing by advising multinational groups in planning, risk management, with TP documentation, TP planning, country-by-country reporting, tax-effective supply chain management in the Asia-Pacific region. And I am Adriana Calderon. I will be co-presenter and kind of moderator for today. I'm the director and technical lead of Asia-Pacific of Transfer Pricing Solutions in the Asia-Pacific region. I'm the co-founder of Transfer Pricing Solutions Asia and Malaysia with more than 15 years of experience. I started my career advising multinational companies in the area of domestic and international tax. And over the past 15 years, I have been, I don't know if crazy, passionate, or lucky enough to specialize in transfer pricing in the Asia-Pacific region. And I think with that, we can go into the agenda for today, because this topic, it is a hot topic, and on top of being a hot topic, is a bit, I will say, technically deep and hard to understand, but I hope that we can do justice today within the hour that we have to explain the basic concepts of global minimum tax. So we will start this afternoon with giving a bit of an overview of what BEPS 2.0 is and why we call it BEPS 2.0. The question is, okay, what is BEPS 1? And then we will talk about the application of Pillar 2, which is part of BEPS 2.0. And then we will give some examples on the application of Pillar 2. So let's start with explaining what is BEPS 2.0 and what is the 2-pillar solution. So as we were saying earlier, if there is BEPS 2.0, there has to be BEPS 1 or first version. So that started for those who don't know the acronym, base erosion and profit shifting initiatives, are some initiatives that started at the OECD level since 2013 to combat basically profit shifting and aggressive to move profits from high tax countries to no tax countries. So BEPS version 1 was all about the implementation of transfer pricing documentation, country by country reporting, master file, local file, together with other measures that are associated with general tax, such as combat of harmful tax provisions and hybrid instruments and CFC rules. So there was about 15 action plans, from which about maybe 4 of them were related to TP. So that was BEPS 1 or version 1. After BEPS 1, which started in 2013 and materialized in 2015, we started to, or governments kept seeing that there are some challenges, and challenges were still there in the context of basically companies, especially in the digital space, reducing their effective tax rate, sometimes to 0, with very, very aggressive structures. So because of that, the BEPS 2.0 was born, which is basically what we call the 2-pillar, let's see if that's going to be the case, the last word, solution. So the ultimate solution, in very simple terms, to combat profit shifting or aggressive profit shifting. So the 2-pillar solution has 2 components. Pillar 1, which is basically the special purpose nexus rule to reallocate taxing rights. Basically, the purpose of this pillar is to move away from the normal international tax rules where taxing rights are directly correlated with physical presence in a country. And it involves a new taxing methodology aimed to digitalize companies or digitalize business that basically cater to B2C or consumers and can still generate revenue without physical presence in that country. So the idea is to create a market nexus rule to create taxing rights even without physical presence. And we will talk in the following slides, but this pillar 1 is. Pillar 2 is basically it has been more famous because of the title of Global Corporate Minimum Tax of 15%. So it has been in every headline in the newspapers because the tagline has been, there is now a global corporate minimum tax for every taxpayer around the world of 15%. For all corporations. So we will explain, and Hongchuan, who is the expert in Pillar 2, will explain whether this is true or not, whether it is true what all the headlines and news are saying, that now every corporation has a corporate minimum tax of 15%. So let's talk about, in more detail, about Pillar 1. Pillar 1, basically, as I was saying earlier, seeks to adapt the international income tax system to new business models through trying to allocate profits where companies are conducting business just by having a market or users in a particular country, regardless of the physical presence. Physical presence understood as a series of things such as having a physical, an actual legal organization such as subsidiary, or a permanent establishment, or a person that give rise to a permanent establishment. So the key is users and market for amount A. Amount B basically is a way to standardize the return for certain baseline marketing and distribution activities. So basically what they are trying to achieve is to create a fixed return for baseline marketing and distribution activities in a particular country, and basically finding a way to reallocate residual profit that usually will be booked in a particular country back to where the company is conducting marketing and distribution activities. So the idea or the goal, or this is in theory, is to improve tax certainty through effective dispute prevention and resolution mechanisms. So in other words, I think what the OECD is thinking is to create, or what it is the objective of these type of measures is to some extent to have a more consistent approach across the world for digital companies, for marketing and distribution activities, and maybe stop the tax competition among countries by having some ground rules that in theory are equal to everyone. So let's talk about amount A. Amount A is the concept that we talked about earlier of bringing taxing rights to the country where there is a market. So there is some things to keep in mind, which is, first of all, who is within the scope of amount A. So amount A applies to multinational companies with revenue exceeding euros 20 billion and profitability greater of 10%. So 25% of the multinational profit in excess of the 10% of its revenues will go to market jurisdiction. So in other words, if I have a profitability greater than 10% combined, I will reallocate the excess to the market jurisdiction when the multinational group satisfies the quantitative nexus test, which will be subject to adjustment under the marketing and distribution profit safe harbor. So basically, the 25% of the excess adjusted profit before tax to be reallocated to the following eligible jurisdictions, where the revenue is greater than 1 million, or if the revenue greater than 0.25 million, where the euro GDP is less than 40 billion. Do you have any comments here, Juan, on amount A?
I think, yeah, one of the things about amount is that even though this, for now, their revenue is above 20 billion, but this is more for transferable purposes and it may reduce further. So for now, I think the objective is just to capture the really big MNCs for now, and then that is forecasted to be reduced, but not sure to what extent.
Okay, so I think another thing that is very important is to look at the profit at amount 8, how amount 8 is determined. So amount 8 profit allocated to an eligible market jurisdiction is determined by the following formula. First, take 25% of the adjusted profit before tax in excess of 10% of the covered group revenues to determine the total amount 8 profit. And then allocate the amount 8 profit to the market jurisdiction in proportion to the amount of revenues the covered group derives from that jurisdiction. So what that means is, I first determine what is the amount of profit in excess of 10%. Once I determine what is the amount of excess of the 10%, I have to split that profit in the eligible countries where I have market nexus. And then I have to choose a proper allocation key within the formula to allocate that profit in the market jurisdiction. So the goal is to reallocate the excess profit above 10% to the market jurisdictions where the country is eligible to that market jurisdiction, basically. So that's amount A. Let's talk about amount B, which, Honchon, just one question. With amount A, we already have final OECD reports on this, right?
Yeah, and yeah, amount B, it's still based on feedback.
Consultation.
Yeah, and still ongoing. There may be changes.
Okay. Yeah, so that, I think that's the difference, right? Which is a bit strange because I'm wondering why they didn't just approve amount A and about amount B in the same time, in the same report, right? So amount B, as we are saying, is basically under consultation at the moment and is meant to be in the sense that at the moment is at the stage where we are waiting for comments from all practitioners on the proposed approach by OECD. So the idea, in theory, is to streamline the application of the arm's length principle for marketing and distribution activities. So the goal is basically to have a global benchmark of what it will be the profit return on marketing and distribution activities. So the scope is buy and sell arrangements involving distribution of tangible property. So it will be for transactions such as sales and agency and commissioning arrangements, which is still under discussion if this methodology does work for sales agencies and commissioning arrangements. And for distribution of services is still also under discussion, and digital property. So at the moment, the agreement for now is that the scope should be for distribution of tangible property, and then OECD is waiting on comments on whether it is useful for sale agencies, commissioning arrangements, and for distribution of services and digital property. So what is the idea? The idea is that we use what we all know as a methodology or worldwide methodology for testing distributors, which is the transactional net margin method. But the data for that global or that standardized application of TNMM will be based on global pool of companies undertaking wholesale distribution. So the idea is that there is a pricing matrix approach with global data for wholesale distribution. And then the mechanical pricing tool will be what profit level indicator will be used, which at this stage, what the OECD is saying is that we will be using what we know as operating margin, which is operating profit divided by sales. It is still under discussion if under certain circumstances, for some distributors, we could accept other types of profit level indicators, such as net cost plus or pay ratio. So I guess the intention is good for amount B. I think there is some concerns, which I will say that will be here. And it's like, if you relied on global pool of companies, so is the OECD intending to do this by industry in the pricing matrix approach? So in other words, like a bit like ATO does it, which is ATO in one of the practice guidance, they give distribution operating margin expectation by industry. So that's one question. The second question is, can I really compare a developed country versus an undeveloped country in a global pool of data? So to me, those are two unknown questions that might make practically difficult to apply this amount B. Do you have any thoughts on this, Hunchan?
Yeah, I think that's a constraint using a global pool, as we all know, every jurisdiction. If you look at the property factors, using a global pool may have a lot of limitations and constraints, which I don't know, may make the outcome, the results sort of borderline redundant or not that reliable or useful. So yeah, I guess I'm sure they would have, I guess that's why amount B takes a little bit of feedback and through the consultation draft, where they are trying to see what kind of other approaches that can be used to better use the method, the transaction net margin methods on a global basis, right? So that's where it lies.
If you think about it, what Australia has done with the practice guidance on distribution margins, what we have experienced from the Australian side is that a lot of the times those operating margins that are indicative then tend to be to some extent unrealistic. Even the same happened, for example, in a place like Vietnam, where there is some indicative margins for toll manufacturers and distributors as well, and they tend to be very high and very hard to achieve, and the same with India. So I think there will be definitely some constraints in this amount B. We'll see if it really happens or if it just falls into the cracks and doesn't go ahead. So that's pillar 1 in a nutshell. So now we will move to pillar 2, which is the start of the BEPS 2.0, mainly because of the tagline of, okay, now we have a minimum tax of 15%. So it was initially released by the OECD on December 2021. There was an additional guidance now issued in February 2023. So we need to understand first which taxpayers are within the scope. With the Hunchan, we'll talk about it more, but basically, in a nutshell, it applies to multinational companies with annual revenue of more than 750 million euros in minimum 2 out of the past 4 fiscal years, and there are certain exclusions as well. So I think with that, maybe Hunchan, you can talk more about the application of Pillar 2 and the GLOBE rules.
Yeah. Thanks, Adriana. I think the GLOBE rules is actually developing really fast, and a caveat is that the rules are out, and it is deemed as a common approach from all the countries, as it has been agreed within the framework itself to say that the GLOBE rules are a common approach for all the countries. But for now, there are still ongoing developments, not so much on the common approach, but more so on the exception rules, other complicated areas, companies with tax incentives, what are the transitional complications during the process. It's very much similar to when we were looking at the BEPS 1.0, when we're looking at the country by country reporting. Similar thing applies where they have a common approach in place, and then once it has been really implemented, then a lot of complications will arise. Then we see go back and look at the complications, and then come up with further developments as to how to actually tackle those issues. So for now, we'll go through our GLOBE Rules 5-step process, looking at how to assess the GLOBE rules. Then there's a 5-step process in play. Sorry, can you hear me?
Yes, I can hear you.
Okay, yeah, yeah. I think the internet connection is not that stable, but yes. So the first step is to identify the MNC in scope MNEs to the globe rules. Then second step is to compute the globe income. Third step is to compute the adjusted covered taxes. Then step 4, which is to calculate your effective tax rate leading to the amount of top-up tax that is required to be paid. And then obviously step 5, which is the payment of the top-up tax, right? Let's go through the first step, which is to identify those MNEs groups that are within the scope of the globe rules. So as Adrian has mentioned, for now, they are using the country by country reporting threshold, which is a consolidated revenue of above 750 million euro for at least 2 out of the 4 previous years, right? So that is when you'll determine based on the consolidated revenue, right? And the consolidated revenue here, definition is similar to the CBC reporting. So that's where they are leaning towards. And then, the financial year then is determined by, referencing to the annual accounting period of the ultimate parent entity, which is also similar to the country by country reporting. Then upon the additional guidance provided by OECD recently in February, the threshold, are we still in step 1?
Oh, okay.
Sorry.
That's what I was gonna ask. Yeah.
Yeah. So the threshold, we're still looking at the European based, but as you know now, a lot of countries are going to implement the globe rules, and they may have local currency in place, and the guidance states that, to sort of reconvert that currency, the rate can be used as at the average for December prior to the relevant calendar year, right? So the European Central Bank rate then should be applied. So that's the 750 million. So once you have identified the MNCs that are in scope, then you need to look at the constituents entities. It includes all the group entities, and including PEs, permanent establishments. So then PE will then need to be treated as a separate constituent entity, right? Those that have done PEs, that we know that it may be combined into one. So it needs to be separated from the main entity and any other PEs within the main entity. Now, there are also entities that are excluded, we deem it as excluded entities. So these entities are, government entities, international and non-profit organization, and also pension investment real estate funds that are the ultimate parent entity of the MNE group, right? The last part is if these funds are actually the ultimate parent entity of the group, then they are considered excluded entities. That the main goal, the main definition of excluded entities are those entities that, they hold assets or invest funds, and or only carry out ancillary activities. Then those can be defined as excluded entities. And this scope will, I think, more or less OECD will actually sort of relook at the excluded entities if there are any, outliers within the definition itself. Then once you have taken out the excluded entities, and also just to highlight that the 750 million is based on the consolidated revenue, so it may include these excluded entities as well, right? So bear that in mind. Then the last part, which is the location of the constituent entity, is actually based on their local tax treatment. So the first hierarchy is looking at which tax residence are they within, and if they're not able to determine that, any other cases, then it will be based on where they are created, where the entity is created, right? So the P is located in the source jurisdiction, where it's treated as a P, right? So that's PE, and there are other special rules that may apply to PE as well. So that's the general rule for the location-based constituting entity. Okay, so the first step would be identify MEs. Once you have identified that, then we have to go through step 2, right, which is computing the group income. The starting point of computing the income is actually to look at the constituent entities' net income or losses. So this net income or losses is actually used for preparing your consolidated financial statements. So when you prepare, it has all the figures, and prior to the elimination of the intra-group items, right? So before consolidation, right, you have all the actual net income or losses. That's where you use that financial accounting net income or losses. Then after which you perform adjustments to the income or losses, right? The adjustment is based on several items. Adjustment can include net taxes, expenses, you exclude dividends, exclude any equity-based gain or losses, including like disposal of assets and liabilities, forex asymmetric forex gain or losses. There are a lot of adjustments in place. So these are just some examples that can be adjusted. It includes also the international shipping income as well. Also the stock-based compensation. Right. So once you've gone through that adjustments, then you have the globe income. And for globe income, right, it allocated between PEs, for example. Then this needs to be separated and allocated accordingly, right? These allocation rules ensure an appropriate allocation of financial net income or losses of these entities. So bear that in mind when you have PEs. So when you have PEs, the calculation may need to be allocated accordingly based on the local tax rules. Then after which we go to, once you have got the globe income computed, then the step 3 is actually to look at your covered taxes, right? So this is where you look at how much taxes in relation to the constituent entity are covered. So the amount is determined by taking the constituent entity's current taxes for the fiscal year, and then you adjust to reflect any timing differences. So the first point of contact is looking at the current tax expense accrued through the financial income, net income or losses. Then adjustments are made to that. Adjustments includes tax credits that are refundable. So if you have tax credits that are prorated for 4 or more years, then it is treated as a reduction of the covered tax as and when the credits are granted, right? So only that in that particular income year. And on the other hand, if you have qualified refundable tax credits, which must be paid within the 4 years, then these are added to the covered taxes where those credits are used to reduce the current tax expenses, right? So that's how you compute your covered taxes. And then your adjusted covered taxes includes adjustments such as your total deferred tax adjustments, amounting to, you have to take into account the temporary differences and prior losses into account for group purposes. So the adjusted covered taxes, I think more so for tax accountants would have better idea on you have your deferred tax assets and deferred tax liabilities to be taken into account. And then there are also a number of safeguards that's designed to sort of protect the integrity of the effective tax rate calculation under the global rules. And these safeguards include limiting the recognition of the deferred tax assets and liabilities to the minimum rate, and a recapture rule to ensure that the amounts claimed as covered taxes are actually paid within a set period of time. Then, I mean, if let's say the DTA and DTL are more complex, then there is also a simplified loss carried forward equivalent sort of simplified calculation based on the simplified loss carried forward in replacing the DT deferred tax accounting rules, which may provide a more appropriate recognition of losses in no or low taxes jurisdiction. So it really depends. You've got two approaches. One is looking at your DTA and DTL. The second approach is to looking at just looking at the simplified loss carry forward and then adjust the adjusted covered tax accordingly, right? So once you have done that, when you have the adjusted covered tax in place, then we go to the step 4, which is of the main thing, computing the effective tax rates as well as the total top-up taxes. Now, to calculate the ETR, you have to sum up all covered taxes and group income of the constituent entities for each jurisdiction. So previously, we have gone through the constituent entities part. Once you have gone through all the entities, then you add up all together in each jurisdiction, right? So if you're Singapore, then you have all entities in Singapore add up, summing up together. And the formula is effective tax rate equals to adjusted covered taxes divided by group income, right? The objective is to simplify this process. When the effective tax rate is below the minimum rate, which is now 20%, the top-up tax percentage is the jurisdiction must be calculated, right? So the effective tax rate, the top-up tax percentage goes to ETR, right? Minus the minimum rate. So if your ETR is 10%, then your top-up tax percentage will be the global minimum tax, which is 15% minus tax 5%. And then after which the top-up tax percentage is then multiplied by the excess profit in that particular jurisdiction to determine the amount of top-up tax to be incurred. And bear in mind that this excess profit is equals to group income minus the term substance-based income exclusion. Now, what is this substance-based income exclusion? It actually a substance carve out, excluding from the group tax base, which uses the reference on fixed return on assets as well as payroll expenses, right? So the amount is actually the sum of 5% of the carrying value of the tangible assets located in the jurisdiction and 5% of the payroll costs for the employee. For now, the transitional period is to calculate based on the 10-year transitional period is actually 10% of the carve-out rate for the payroll costs, as well as 8% for intangible assets. And then these will then slowly, gradually go down to 5%. The reason for excluding this substance-based income exclusion is because of one of the ways is actually to tackle jurisdictions that are still allowing for tax incentives, right? The substance carve-out actually allow a jurisdiction to continue to offer tax incentives that reduces the taxes on routine returns, right? So when you have tax incentives, generally, their objective is to actually look at your routine objective returns and reduce that potentially to 0% from investment in substantive activities, right? For example, in Malaysia, Singapore, we have a lot of tax incentives that's still occurring, and there are a lot of misconceptions or a lot of questions in relation to those jurisdictions that provide tax incentives, right? So what if Malaysia provides a lot of tax incentives? That potentially makes our effective rate to actually lower our effective tax rates. So what will happen to us, right? So this is one of the the factors that is put in place to actually carve out these substance-based entities that are receiving tax incentives. And another thing is, if you look at, it has two substance. One is to look at the tangible assets base. The other one is to look at the payroll cost base, right? So hence, it includes both of these elements on the basis that it can cover a broad range of industries. So normally, if you look at tax incentives, Malaysia, for example, it has your hubs, which is labor-based, and then you have your green tech or your manufacturing in certain areas where you can then apply for tax incentives. So these two will almost cover all the industries where they are taking advantage of the tax incentives, right? That's the main basis of having the two elements in there. So for those that are receiving tax incentives, these are the sort of safe harbor that are included when you're actually calculating the top-up tax. And then after looking at the excess profit, right, then we have another layer, which is to take out the qualified domestic minimum top-up tax. So this one, I will actually explain in detail what it means and what it entails. So once you have gone through that, minus the qualified domestic top-up taxes, then I'll call it QDM. Then you have to assess whether you have any leftover top-up taxes to be allocated, right? So that's how you calculate top-up taxes. And then also we have a de minimis exclusion, which is the safe harbor, which also I will go through in the later section, where for jurisdictions where they have MNEs that has below 10 million revenue, then below European 1 million income. So step 4 is to actually calculate the effective tax rate and the amount of top-up taxes you need to pay. Then next step 5, which is payment. Who is actually responsible to pay top-up taxes? When we first look at the top-up tax, it was based on the income inclusion rule on the parent entity, right? So the responsibility actually lies with the ultimate parent entity, and any residual amount of the top-up taxes will be based on the income inclusion. There's two approaches: income inclusion rule as well as the undertaxed payment rule. So it will be, the hierarchy is you go through the income inclusion rules first, then after which, if you have any residuals, then you have a backup approach, which is the undertaxed payment rule in place to neutralize the top-up taxes. So the first up, which is the income inclusion rule. So the income inclusion rule is when the ultimate parent entity of the group is actually primarily responsible for the top-up taxes. That is if the parent entity actually has the group rules in place. And it actually follows a top-down approach where if, let's say, the ultimate parent entity's jurisdiction does not or have not implemented the group rules, then it falls down to the next level, which is the next intermediate parent entity, right, downwards to the ownership chain, until the parent entity that has that group rules implemented. That is where then the entity itself will be responsible to pay the top-up taxes. And the allocable share of top-up taxes is determined based on the parent's inclusion ratio, which is the share of the profit of the low-taxed entity attributable to the parent entity on the basis of the accounting standards, right? So based on the share of profits itself, if you have several parent entity that are shareholding to that particular low tax jurisdiction, then you need to look at which parent entity has a higher shareholding interest in the ownership structure, right? Then that parent entity will be liable, and then we actually prorate it accordingly. So that's the income inclusion rule, right? Looking at the top-down approach, looking at which entity is actually responsible to actually pay the payment of taxes. Then once you have gone through the income inclusion rule, the under-tax payment rule is actually the other way around, right? So if there is a low-tax income beneficiary owned by a OUP, but it's not under the GLOBE rules, for example, then a fallback approach is then to look at the low tax jurisdiction. And so this low tax jurisdiction, but how we approach the under-tax payment is that you look at two factors, allocation key, which is the net book value of the tangible assets and the number of employees employed by the constituent entities. Then once you have gone through that, you allocate it based on those two approaches by way of deduction denial, right? Or any deductible expenses. So instead of the parent entity responsible of paying the top-up taxes, this underpayment tax will then use the deductible denial as well as the other expenses actually increase the effective tax rate to above, to become effective tax rate to be 15%, right? So it will be a fallback approach whereby you actually neutralize the top-up taxes, right? So that is when we look at the underpayment taxes. And then lastly, we also have exclusion from the underpayment tax payment rule for MNEs with operations in less than 6 jurisdictions, as well as when you have a maximum of European 50 million intangible taxes assets in place, then that's an exclusion from the under tax payment rule. Well, I hope that sort of sums up the the payment of top-up taxes. So to wrap up, right? Yeah.
Yeah, maybe with the examples will be a little bit clearer at least.
Yeah. Yeah. Then we'll go through the case studies later on. Then you hopefully will have a better idea when it's illustrated. Okay,
So,
before going to the case study, as I mentioned earlier, we have the the exclusions, which is categorized into a transitional safe harbor as well as the permanent safe harbor. Now, as the main name suggests, the transitional safe harbor is similar to the CBCR. You have a transitional period from 2023, but then most likely 2024 onwards, where you have a transitional period of maybe 3 to 5 years for constituent entities or MNEs that can use these tests to at least get out of the GLOBE rules for now until a certain period of time, where then you have to relook at your GLOBE rules. Now, this transitional safe harbor is actually temporary. And when you meet this test, then the top-up taxes will then be 0, right? And the first one is the de minimis test, which is rather straightforward, where the jurisdiction has a total country-to-country revenue of less than euro 10 million, which is based on the definition of CBCR, and the profit and loss before income taxes of less than European 1 million. Right. So if you have this breaches test, then yeah, you will not need to actually pay any top-up taxes. Then you have the next one is simplified effective tax rate test. So here is when the jurisdiction has an effective tax rate equal or greater than the transition rate. For now, the transitional rate is as follows: 15% for 2023 to 2024, 16 and 16% for 2025, and actually 17, if I'm not mistaken, there's a typo, maybe 17% for 2026. Now, when the keyword is simplified effective tax rate, this simplified effective tax rate is actually calculated by using a simplified calculation, right? Which is income tax expenses reported in the M&E's financial statements minus any taxes. They are not covered taxes. Then by the profit or loss before tax reported in the M&E's group's country by country reporting definition, right? So the objective is that instead of going through the rather complicated calculations, going through the global income, globe income, as well as the adjusted covered taxes calculation, we fall back to the CBCR calculations, which is more so a simplified calculation to come up with the simplified effective tax rate. So the objective is actually to relieve the burden of the M&Es to come up with, to see whether you fall within the effective tax rate as per the transitional safe harbor. And then the last one is the routine profit test. Now, this routine profit test is actually tested jurisdiction's P&L before income taxes for the respective jurisdiction, whether it's equal or less than the substance-based income inclusion, which I have mentioned earlier in relation to the, based on the assets and also the payroll costs for the constituting entities in that particular jurisdiction. And also, again, based on the country by country reporting definition, right? So you have to go through this routine profit test. And then if it's equal or less than, then you are not required to pay the top-up taxes. So now the next one is more the permanent safe harbor. So once you have gone through the transitional safe harbor, then there are also avenue for safe harbor going forward. Very similar to the transitional one. It would reduce the top-up taxes to 0 if you meet any of the criteria. And the key point is to have M&Es to avoid to perform, again, the more complex globe calculations and to use a simplified calculation first and to calculate or to meet any of these criteria so that at least it sort of relieves the M&E's compliance burden to go through all the calculations. Again, I think it's very similar to the transitional one, routine profit test, whether it's equal or less than the substance-based income inclusion, whether it's nil or not. Then de minimis rule, which is also similar, 10 million and 1 million of the income. And then effective tax rate, which is at least 15%. So the main difference is you're using a more simplified calculation. It really saves a lot of time and burden of the taxpayers to actually go through the complex one. So that is the sort of avenue for M&Es to relieve their burden and to ensure that if you actually meet any of these tests, then you actually do not need to actually pay any top-up taxes. So there are safe harbor in place, and these may change, but for now, these are the safe harbor criteria that are available to the taxpayers. Okay. All right. So I've gone through the safe harbor, which is the exclusions. And as I mentioned, I want to talk more about the qualified domestic minimum top-up taxes. I'll term it as QDM for now, QDM. So what is QDM? Malaysia is one of the countries that are implementing QDM. I think there are a few others that are implementing QDM. what is QDM? I mean, if you look at the domestic structure, is that jurisdiction can actually opt to actually implement QDM, which is actually beneficial to the respective jurisdictions, as any top-up taxes will flow back in domestically where income is derived, right? So it takes into account tackling the issues with developed countries versus developing countries, right? So a lot of developing countries are looking at the group rules rather closely because it really would affect how they look at the top-up taxes, right? If there are no domestic top-up taxes in place, then if you look at it this way, a lot of developing countries would have tax incentives trying to incentivize foreign companies to actually invest in the company, right? So when you have tax incentives in place, right, sometimes even other taxes to actually incentivize foreign companies, then effectively the jurisdiction would have lower effective tax rate for the jurisdictions. So when you have that, then by right, all the taxes are actually calculated through that, then the developing countries may be disadvantaged. So there's an avenue for local jurisdictions to actually apply this QDM, where you look at the similar applies, the implementation, administration will need, the design itself will need to be similar to the group rules. And the main objective is actually to determine the domestic excess profits, which is similar to the group rules as well. So the calculations, everything is the same. And one key difference is that it doesn't include the substance-based carve-out or any diminished income exception, right, when calculating the QDM. So in essence, it can be customized by the local government for each jurisdiction. So in Malaysia, they are implementing, but we have yet to see the full picture of what it implies, what entails within the QDM rules, right? Obviously, the common approach will apply, which is similar to the globe rules, but they can customize the QDM. And obviously, there will be possible safe harbor in place depending on the local jurisdictions. And then one thing I need to highlight, right? A lot of taxpayers looking at BEPS 2.0, hey, that may not apply to me because my company is not even above that CBC threshold anyway. And if I'm not even eligible for CBC, most likely the pillar 2 will not make sense to me. Now, this qualified domestic QDM has a special circumstance. It can, depending on the local government, it can be applied to groups below 750 million. And it can be applied to groups that are purely domestic, right? So a lot of taxpayers in Malaysia will be looking at transfer pricing initially, saying that, oh, I've got all domestic. First question is, I've got all domestic entities. Why do I need to bother about TP, right? Obviously, we look at the effective tax rate within Malaysia, right? And if you are one of those that has loss-making tax incentives, then you fall under TP. Now, with QDM in place, you may still fall under QDM, right? So having this session is not just about looking at what BEPS 2.0. I mean, I've gained some knowledge, but may not apply to me. But with QDM in place, it may apply. So we have yet to see what's the threshold for QDM. Judging by the various governments and also the KPIs that tax authorities wanting to obtain more funding, I will assume that this threshold will be lowered down much more to actually capture a much bigger pool, and that creates a problem to a lot of taxpayers domestically, right? So bear that in mind when you have the QDM in place.
Thank you, Honchan. That's a really good eye-opener to everyone that maybe needs to then consider this QDM. Let's go very quickly because we're running out of time through the case studies. So we can just look at some of the things that we have been discussing on globe rules, which very well done, Honchan. I think you have done justice to such a hard, dry topic and difficult and technically challenged. So let's see this example. Company A, B1 and B2 and C are members of the ABC group with past annual consolidated revenue as follows. Year 1, euro 800 million. Year 2, euro 730 million. Year 3, euro 850 million. Year 4, euro 950 million. In year 5, CA company A, B1, B2 have an ETR, an effective tax rate, above 50 million. Company C has a globe income of euro 10,000 and adjusted core taxes of euro 1,250. So the questions are, and maybe I'm trying to think, I go to the questions and I come back to the case. So the questions that we're going to test Honchan on, and whether he did the homework, is the following. The first question is ABC Group subject to the globe rules?
Yeah, okay. So first step would be to look at whether your the M&E is actually in scope, right? So the criteria is actually 2 out of 4 years above 750 million. You look at year 1, year 2, year 3, obviously these are already simplified. The 3 out of 4 years are above 750 million. So which means they are in scope, right? Then after going through in scope, you have to go through the steps again to look at your constituent entity, assuming all constituent entities are not excluded entities in this scenario. All these are also included in there as well, looking at the constituent entities part. And then from there, that will know that they are actually in scope.
Okay. So then the second question is, what is the effective tax rate of in country C?
Okay, the next step would be compute globe income and also compute covered taxes. In this case, has been simplified for us. Because we don't want to include examples because the calculation of globe income can be complex. So for these purposes, the globe income is euro 10,000. Adjusted covered taxes is, after calculation, is euro 1,250. And to calculate the effective tax rate is actually to use the covered taxes divided by the globe income, and you come up with a 12.5% of effective tax rate for country C.
Okay. Do you think it's better if I go back to the case and we go through questions, or is that okay?
I have all in my mind.
Okay. Just for example purposes for people. So what is the amount of top-up tax for company C?
So once you have calculated the effective tax rate, right, then you have to calculate the based on the excess income profit. And to simplify it, the excess profit is actually 10,000. And then you use the effective tax rate times the excess profit, which equates to European 250. So 250 is a top-up tax for company C.
Okay. And then the question is, and maybe for this one, I do go back to the diagram, is which entity is liable to pay the top-up tax?
Yeah, I think it's good to look at the small tax at the bottom. Now, in this case, if you look at 3 different jurisdictions, first jurisdiction, obviously they're above 15%. A and B is above 15%. But then the key point is A do not have any globe rules implemented. B has globe rules implemented, and C do not have. Right. Then from here, generally speaking, if company A has global rule in place, company A should be responsible. But in this case, country A does not have group rules implemented yet. Then we have looked down to its company, down the ownership structure, which is company B and B1 and B2, which is country B, where globe rules are implemented. Then from there, we can say that country B is actually responsible for the top-up taxes.
Okay. So we have case 2, which is a variation of case 1, but we have a couple of different facts for the ownership structure. So what we have now is that company B is owned 80% by company A and 20% by company D1. And company C is now owned 100% by company B2. So the question is, which entity is liable to pay the top-up tax and how much?
Yeah, the objective of this case is just to showcase the who is paying it, right? Now the changes is that country B2 actually owns 100% of C, and if you look at B, indirectly they're owning 20% of C. Now, similarly, we look at the group rules implemented, then country B will be responsible. But the question is, which company is responsible to pay the top-up tax? And the main thing is to avoid, I guess, double taxation. In B1 payment of top-up taxes is 20% of 250, which is €50, while B2 will be reduced by an amount paid by B2, effectively reducing the total 250 to 0, right? So that's how the payment works. So in essence, country B will still be liable to pay the total €250.
Okay. And then we see case number 3, which is basically a kind of similar set of facts, or not similar actually, it's significantly different, where we have company A that owns 100% of company B owns 60% of company C, company A owns 40% of company C. So assume that the top-up tax in company C is €250. In this case, which entity is liable to pay the top-up tax and how much again?
Again, this small simplified illustration where we are looking at the income inclusion rule versus the undertaxed payment rule to illustrate when the undertaxed payment rule is applied. So if you look at this case, the key distinction is that now country B and country C has group rules implemented. Then we are looking at first the income inclusion rule, right? Yes, Adriana?
Yes, sorry, I'm mute. Yes.
Okay, yep. So now country B and company B actually owns 60%, right? Based on the income inclusion rule, you look at the shareholding, 60% of the top-up tax will be liable by B, right? So 60% of 250 is 150,
Yeah.
right? So
Yes.
150 they're liable to pay. Then what happens to the remaining 100, right?
Yeah.
So that is where the undertax payment rule applies, where it falls back to country C, where they are liable for that 100, and that 100 can be by way of denial deduction by the tax choice there, or on the deductible expenses as well, to come up to actually then reverse back that €100, insofar that the top-up taxes become 0.
Right. So I think these 3 cases, what it shows is that there is a lot of variables that you have to consider. First, you have to look at the level of tax in each country. Then you have to look at which stage are they in the GloBE rules implementation, then you have to look at the ownership structure as well. So there is quite a bit of variables to determine who is entitled to the top-up tax and how much, right? So I think this is where, and any changes in the ownership structure or changes if whether it is implemented or is not implemented can really affect the answer to that. And then what it also shows is that if a country doesn't implement, then you kind of miss the opportunity to get up the top-up tax. So it kind of can force countries to go down the path of just implementing GloBE rules. I think because we are kind of running out of time, we might have to go through very quickly to the last 2 slides. I think the first thing is just an update on how is the region going with this. Singapore, there is a typo, there is effective, at least in budget, not yet confirmed, from 2025. Hong Kong as well, 2025. One day after Singapore said 2025, Hong Kong also came up with the same. Malaysia is targeting 2024. Australia and New Zealand are in public consultation phase. Indonesia does have some sort of implementation under the omnibus law for digital economic tax for 2022, no action on Pillar 2. South Korea, Japan are the ones who have been ahead saying that they're going to implement it from 2024, January for South Korea and Japan for April for Japan. Vietnam, Philippines, no action. Thailand has draft legislation for 2025. So not only saying that it's going to do it, it's already drafted legislation. So it's a little bit ahead. That's what Singapore, Hong Kong, and Malaysia are kind of saying. And India has no comments on this. So I think with that, we can just wrap up our session because some of the things that we have seen here, but we can go very quickly, which is basically the purpose of at least Pillar 1, which we talk about amount 1 especially, is essentially to prevent tax leakages associated with digital economic companies. So I think digital economic companies have to decide whether they are better off with setting up a physical presence in the form of a PE or a subsidiary to not be taxed on market only and then essentially on gross amounts. So I think that's a big decision for digital company. My bet is that maybe what is going to force digital companies is to come back to physical presence so you have a better outcome from tax point of view. You want to talk about the second one?
Yeah, as I mentioned earlier, I think a big impact is for jurisdictions that are implementing the QDM, which can be applied to groups that are below 750 million euro. So keep that in mind and making sure that you know the local jurisdictions QDM criteria when it will come up going forward.
Definitely, I think while everything settles, there is going to be an increase on tax compliance costs because I think effectively these rules are going to be hand in hand with the TP rule because are not making the TP rules redundant. So I think there is going to be definitely some turbulence in between. So for all of us tax practitioners, I think it seems that we're going to have work for a long period of time. We may have some issues around risk, or maybe taxpayers may try to do restructures to, if the revenue threshold for global minimum tax is still 1 billion, then maybe there could be a tendency to have smaller consolidated groups and then be outside of the scope. Having said that, we don't know if that threshold is going to be coming down in developing countries or under the QDMTT, then that is not a solution basically, because it doesn't matter how big your consolidated group is anymore, depending on how it is implemented, I guess. So coming back to our starting question, will TP be redundant? I actually believe that it will not, because there is still a lot of companies that, as the rules are today, are still outside of the scope. So if you're still outside of the scope, you still have to look into TP like you were looking business as usual. And even if you do, while all countries implement, there will be like two type of rules working hand in hand. So I think TP is not necessarily redundant. What do you think, Juan?
Yeah, I think similarly, I think won't make it redundant. It just make TP more dynamic. In the sense that there are more things to look at right now.
So you will have
can
to
be good, bad. Yeah.
You will have two set of rules basically.
Yep.
Okay, so with that, maybe we in 2 minutes try to answer a few questions. There's only one actually, because one is about the presentation slides, which we usually don't send. There is another question around whether will be coverage on how to comply with 3.23 and 3.27. I'm not sure what the
not this session. I suppose going through the 3.2 article 3.23 to 3.7. I think that's will be another session in relation to quite a few things. I think pricing on the transactions and all that. So definitely not in this session.
Okay. And then there is another question, which is, with Singapore adopting GLOBE rules starting from 1st January 25, should the region be on global basis instead of Asia Pacific region when computing the interquartile range, assuming that the interquartile range, assuming that the TNMM method is used? I think the TNMM method is not part of the GLOBE rules. That's pillar 2. The TNMM methodology is part of the pillar 1, which is amount B. And amount B is probably the one that is a bit behind. So there is still not clear action yet. So I think until we have clarity on how that is going to be applied, I wouldn't move to global benchmarkings unless there is a real valid reason within the domestic TP provisions to do so, because until all of this is implemented, we are still all subject to the local TP provisions, basically.
GLOBE rules equals global minimum tax. I think just better. Yeah.
All right. I think with that we are done.
Took longer than expected.
Definitely, yeah. There is a lot of things to say about this pillar 1.
Not even scratching the surface. lot of things going around. Yeah. That's for sure.
So thank you very much, everyone, for attending to the seminar today. We might do a second round because it has been on high demand, so it was fully booked today. So we might do a second round, maybe in the second part of the semester, and we will get an update on how all of these pillar 1 and 2 is evolving. Thank you, Hon-Chan.
Thanks, Adrian.
I do think you did justice to it. And thank you for being as clear with the session today.
Thanks, Adriana.
Thanks.
Thanks, guys.